Hello, guys. Welcome to this new episode of the second season of Chasing the Deal. Today we are going to deep into a market on the northeast of Midwest of the U.S. It's the top market by inventory. It's over 1 billion square foot inventory. And in the last months, or in the last months, it has experienced some kind of revival after lagging 2025 as the same as the other main markets on the U.S. because of the uncertainty on the tariffs and all this trade economics. And we are watching in this market a new revival, as I said, and we are looking the numbers to grow, like the rent growth, and the asking rent and the absorption. So it looks like they are moving forward with these new investments and new leasing of industrial space. So we are talking about Chicago, Illinois, and today we are going to chase the deal on this huge market. So let me show you this screen of my CoStar software, which is the software where I get all this information, market information. As you can see, we have here many tabs. The tab you are watching right now, it's the markets information. So all these blue dots you see on the map are markets in where you can get data from. Okay, so you see a lot of points on the US, some of Canada, and even if you go to Europe and you want to invest on some industrial, you can do it on the UK. You have plenty of information there. Okay, so for this episode, we are going to deep dive into the market information of Chicago, Illinois. I just want you to see where Chicago is located and why it's the top industrial market by inventory and why it's one of the top logistics hubs on the US. So first of all, it is connected by the Mississippi River, that it comes up all from New Orleans up to Chicago. And yeah, so before the trains and all these things, we use the Mississippi River to transport things all over the US. Okay, it was the easiest way. And also it has another port axis or sea axis through Canada. Okay, you can see through the Gulf of St. Lawrence, I think it's the name. All these vessels or all these ships went through this river and came to the Great Lakes, to the lake. What's the name of the lake? The Great Lakes. I don't know specifically what's it. It's a Lake Michigan. Okay, so you have two axes, water axis, one river axis, and one sea axis, as you can see. And then you have all these, the Midwest Plains. Okay, so you have the Midwest Plains. So basically, it's this line that runs from the top to the bottom up to Texas, from North Dakota, and all these plains are very good to cultivate, especially grains. So in the past, Chicago was a hub spot for trading all these grains. But also in today we have many food coming from Canada. Okay, so we have many food coming from Canada, and also Chicago was a very popular processing food hub. Okay, so you have all these beef processing meat here, meat companies here in Chicago, and that's why it became a trade hub for the US and logistics, especially for food. Okay, so today it's not only, I would say mainly the food will be their main or one of the main things to distribute in Chicago, but it's not the only thing. You can find some other kind of manufacturings, distributions here or logistics companies, but mainly, especially because it's close to the East Coast. Okay, so you are basically 1 or 2 days from all these, from the west, from the East Coast, from New York and these all big cities with where I have said before, I have mentioned before that it's half of the population. Okay, from here, from this line, it's almost half of the U.S. population on the East time zone. Okay, so you are in Chicago, you have a pretty good location for distributing all these things for logistics. And also you can see all these highways you have on Chicago, plenty of highways, okay? Especially, for example, this is the 90 highway, interstate. It comes all over to the east to New York, okay? And you have also highways to the south and basically all over the country, and to the west, to Iowa, for distributing all these grains, all this food. So basically, it's very well connected. Okay, so that's why it's basically, I would say, the top spot for logistics on food. Okay, so that being said, let's deep dive into the market, into the numbers. So basically, if it's not the first time you are watching me, you are already know what these numbers are. Let me to reload this thing because sometimes it gets laggy, but let me just reload. Okay, let me see. Okay, so here we have the top KPIs or the top numbers you must see or you must watch on if you are looking to invest on a market. Okay, the first number you will see is the inventory. So the inventory is basically the total square footage or the total space on this market. So Chicago is the number one. It's bigger than Dallas. Okay, so I think Dallas forward is number 2 on inventory, or I don't remember if it is Los Angeles, but it is between Dallas and Los Angeles. But for sure, the top hub, the top market is Chicago. It's 1.4 because Dallas maybe it's huge, but it has been growing only on the last years. Okay, maybe the last decades. But Chicago has been a top logistics spot for over a century. Okay, so that's why you have the highest space here. So basically, you have almost 1.4 billion square feet here in Chicago, and you can see this number, the change. It's basically the new inventory that was built and made available. So that means this is the I forgot the name. The basically is the delivered space. Okay, is the space that was delivered. So that is 7 million. So that is an increase of 0.5% or 500 basis points, as economists say. For Chicago, I would say it's not a big number. Okay, so if you compare the delivery space with the amount of space that it's already on the inventory, it's less than 1%. Okay, it's very, very few, but at least it's something because it indicates it's growing. And especially you have also this number, the under construction space is basically the confidence of the developers that they are starting to build new space because they are confident that new space is being demanded. Okay, so basically you have here under construction, even if you only delivered 7 million last year, you now have under construction 22 million. Okay, so it's a growth. It's an increase of 48%, almost 48% from the last year, where on the last year was 14 million, and now it's 22 million. Okay, so that indicates a confidence because remember, after the pandemic, all developers start building new space all over the U.S., especially on industrial, because everyone was thinking that everyone will move to online. Okay, so if it will move the retail and everything, basically the retail. Okay, so because you cannot go out. Okay, so basically they started building these new distribution centers for online sites like Amazon and all these online shopping. And also the effect of the pandemic was that many companies started to stock inventory. Okay, because they didn't know, because all these ships were not traveling all around the world, and they started to buy more and hoarding more inventory. Okay, and they needed more space for that. So they called, in manufacturing you call just in time because it's very efficient. It's a Japanese technique that you build the things. You don't have inventory basically in just in time, and they invented this new term that it's just in case. Okay, so just in case you will need more inventory because you don't know what will happen around the world. Okay, it's more efficient to have no inventory for sure, because you don't have all that money basically stocked in a warehouse, but you don't know if something like a pandemic or something it's going to happen. So just in case, you bought all that inventory and store it somewhere. So basically that's what made all these developers start building all this space. But then after the pandemic, everything became to normal, and then they realized that we have an over inventory. We have more space than needed. Okay, so they stopped building new space, and now just after like 4 or 5 years, we are seeing, I think this is the first or second year, we see an increase of the under construction space. Okay, it's because all over the country we have oversupply. Okay, but this is the case in Chicago. We are having this confidence from developers to build again. Okay, because the space, the excess of space they built before has been absorbed by the demand. Okay, so this is the next number, the absorption. Okay, what's the absorption? Basically, is the demand part of that of the market. So basically, as you can see, net absorption here in Chicago, it's last year it was 9.5 million. So you can see was over the supply. Okay, supply was 7 million and demand was 9.5 million. That's why the developers start building again. Okay, because they need more space. Basically, 2 years ago it was negative, the absorption. So that means more tenants are moving out than tenants moving into the market. Okay, so absorption is basically new tenants moving in or existing tenants expanding. Okay, so it doesn't count same space renewal. If you have a tenant in a warehouse and he renews the lease, it doesn't count into the net absorption, only if the tenant is actually expanding. Okay, but you count new tenants moving in and absorbing or demanding that space. Okay, so that's basically the demand part. And then you have the vacancy here. So the vacancy last year was 5.44%, which is under or below the national average. Okay, you can see a change here of 200 minus 200 basis points. Okay, so it's a decrease of 200 basis points. So that means the absorption, it's the vacant space is absorbing that demand. Okay, so that's why you see decreasing. Then you have the market asking rent. You can see here an increase of almost 5%. Almost 5%, or 50 cents per square feet. And today the rents, the average, it's $10.28 dollars per square feet. Remember, this is an average. This counts not only new space, but old space, and also not big space, not only big space, but small space. Okay, even flex space counts in. So you have this number, market sale price per square feet. Again, this is an average. You have new space and old space. So the average was $103 per square feet for sale. Okay, so that is an increase of 6.33%. Usually this means the market is moving into new space. If you see this number actually increases, it usually means the market or the buyers of this market are purchasing new space, and since the new space it's more expensive than the old space, you see these numbers growing. So you also finally you have the cap rate. Okay, so the cap rate last year it's 8%, down from 8.08%, down from 8.17%. Okay, So a little decrease of 1%, but it's good because when the cap rate compresses, it usually means the market is getting hotter, okay, or the properties are appreciating. So you have a summary here of the market. For example, let me see. You can see the supply. Developers delivered just under 11 million square feet during 2025, 50% below the decade-long annual average of 21 million square feet. So basically, they are starting building again. 22 million square feet under construction from 15 million a year ago. This is important. Roughly 55% of the pipeline has already been released. That indicates a strong demand. Okay, even if construction has been accelerated in the last time, the timing of future completions should allow demand to absorb much of the incoming space before the deliveries return to more typical levels. Okay, these fundamentals continue to support the rent growth. And growth remains the strongest among the newer logistics facilities. This is important. Growth remains strongest among the newer logistics facilities larger than 200,000 square foot, where availability is more limited and tenant requirements have become increasingly specialized. Older, less functional properties continue to record moderate rent growth. Okay, so that means we are basically in a distribution market. This is not like a last mile or flex space market. This is more like a distribution, okay? Because most of these tenants, over 200,000, are logistics companies, okay? And usually logistics that lease this amount of space, they are looking to distribute, okay? They are looking for distribution centers, so they have future inventory or a space, warehouse space, basically. Trade policy change and broader economic conditions remain important variables, but occupiers have demonstrated an increasing ability to adapt supply chain strategies as policy directions has become clear. As a result, vacancy is expected to remain relatively stable while rent growth continues to outpace national average. So I think this scenario we see here reduces to here. The trend as I mentioned, Chicago depends a lot from the plains, all these food produced on the plains, and also in Canada. Okay, so all this food, a large size or a large piece of this food comes from Canada. So recently, we knew that the USMCA free trade agreement has not been renovated, will not be renovated, okay, or renewed. So that comes with this decision, it's annual reviews. I think it will be renewed, but it is more favorable for the U.S. administration to take this decision because they will review every year. So they will have a strong negotiation position. Okay, so once this decision was taken, I think that's why that's what many of these companies were looking for, were waiting for, some kind of clarification or certainty about what's happening with the trade agreement. Okay, so probably many of these distribution companies that are coming to these 200,000 and over square feet spaces are companies distributing something from Canada. Okay, I guess that's my guess. I didn't find any information here. We have to see maybe the new tenants that are leasing this space. We have to research a little bit more, but that's my guess. Okay, so because they were waiting for something, and we see. So the thing is, this, I don't see a trend here. Okay, I don't see a long-term trend. I see something more more immediate. So probably these companies were waiting for that decision, and then they were waiting for this clarification for the trade agreement, and then they are now taking the decisions to lease. But probably it's not a trend. It's just they were stopping to decide to lease or not. So we have this. If you want to compare these numbers with the nationals, we have this part of the report. For example, the market asking rent is $10 to 28 cents, while the national is $12 per square feet. So we know we are below the national. Even if Chicago, I think Chicago is an expensive market. I don't know. I don't live there, but this is interesting because I think it will be over than the national rather than below the national. So we have also the vacancy rate, which is 5.4%, while the national is 7.5%. Okay, vacant space, availability. For example, you can see you need to learn to read over the numbers. For example, we have here the available space, okay, or availability rate. We have an availability of 8.6%, while the vacant space is 5.4%, okay? But you see most of the available space coming from the direct space. What does that mean? Direct. That means that probably you have a lot of space under construction and you are pre-leasing all this space. Okay, so that space that is under construction, and if you are building a big warehouse and you are before it is available to move in, you can release it. Okay, so all this available space can become this, even if it's not already built and ready to move in, it's available for pre-lease. So I guess all these numbers, much of these numbers, 109 million square feet, comes from pre-lease space that it's already not available to move in, but it's pre-leased because the report says almost 50% of pre-lease space of under construction space has been pre-leased. So that means that shows, or it's an indicator that we have a strong demand. On the other hand, we have the sublet space. Okay, usually I mentioned before, when you have the sublet space rising, that means the companies, the tenants that are inside those buildings are uncertain to renew those leases or are not willing to renew. Probably they are going to reduce the space, okay? Because they are trying to get rid of that extra space, okay? But when you have a reduction on the sublet space, that means those properties, those companies, instead of trying to get rid of extra space, they are looking probably for more space. So these two numbers are a strong indicator of that the demand will be strong in the next years. Okay, because these sublet, because companies are not trying to get rid of the extra space, and this direct because it shows that the builders or developers are pre-leasing the space before it is built. So that's a strong indicator of future demand. Okay, months of market absorption, you can see the rise here, change 10.5 million absorption. The average cap rate on the market, 8.08%, while national 7.4%. But compressing, the cap rate is compressing. So then you have these key performance indicators for if you want to compare for other data for the same market on other years, you can go to this part of the report where you can set the timeline, like 5 years, or I always set it as 10 years, and you can see where are you positioning right now. For example, the vacancy, it's 5.44%, while last year it was 5.7%. Okay, so you see it's moving in a good way. Net absorption, 9 million, while last year was negative and on the extreme range. Okay, so this is the typical range or the normal range of the curve. So net deliveries, asking rent growth, you see the rent growth moving up, rent all-time high, sale price also all-time high, market rate, cap rate moving from extreme high all the way to to the normal range, or in the middle of between the normal range and the extreme range. Okay, so let me show you some important data about this. For example, on the leasing, demand continues to favor modern logistics facilities. The average lease size increased by approximately 35% over past year. So, as I said, this is a market for the big players. Thought leases below 10,000 square feet still accounted for 60% of all transactions. I think this number is wrong because 10,000 is too small to have 60% of all transactions. I think this is 100,000 probably. We have to double check. So logistics assets larger than 200,000 square feet built within the past 5 years accounted for roughly 90% of total net absorption, while logistics properties smaller than 200,000 square foot, built before 2020, recorded negative absorption. Okay, so basically, the market is moving for new properties, for big new properties. Okay, these trends are most evident with large format segment. Buildings exceeding 500,000 square feet built since 2010 have continued to outperform, with vacancy declining by approximately 450 basis points over past year to roughly 5%. Okay. They are looking for sure for high clear heights, 36 feet and over. Okay, net absorptions. You can see, for example, on the next quarter, on the third quarter, net deliveries will surpass net absorption, and then it will be mostly the same on the next years. Okay. Leasing activity, daily vacancy, months vacant, it's 7 months. See the vacant, median months to lease, 5.9. Okay, so that means if you see months to lease lower than months vacant, that means you have a pre-lease space. Probability of leasing in months. Asking rent growth. This is important. Here's where you see this is not a long-term trend. Okay, so something happened here on the third quarter of 2025, between the third quarter and the second quarter of 26. Something happened that make this companies, especially logistics, take the decision to lease more space. But as you can see, we are now on the peak of rent growth, and then we are going to drop. Okay, we are on logistics at least. We are on at 5.6, and then let's say on the first quarter of 28, we will be on 3.8 year-over-year growth. So that means if we invest in something right now and get it leased, or we purchase something that it's already cash flowing, we can sign for higher escalations than if we purchase or build something. If we develop something, we may lose 200, more than 2%, more than 2% in 2 years. So that will be better to acquire something today and sign the escalation, higher escalations, than develop something and then sign lower escalations. Okay. And we only see this peak on the logistics. The other types of assets are not having this peak, especially specialized. It's not having a peak. Construction, under construction, sale price, economy. Well, the economy of Chicago, it's pretty well diversified. As you can see here, we can see most of the jobs are on transportation and logistics. Okay. We have many jobs, for example, on professional and business services, because Chicago is a financial city. Okay, so we have all these banks or financial services firms or companies trading basically commodities. And then we have a lot of universities also here, but I will not say this is a market for a flex space or something that it's more into the consumption of the city, but it's more a market for distribution, because you can see here the job growth. We have a job growth close to zero. Okay, so that's not good. That's not good for small bay or for flex spaces. That's not good if you don't have a job growth. The unemployment, it's on the average, yeah, but you don't have job growth. And also, you have median, I would say medium to high household income. But this is important, the population growth. Population is decreasing. So you don't want to invest in a small bay here. At least I will not invest in a small bay here. At least on development. Probably if I find some good prices, small bay warehouse or building, I will do, but I will think it twice, because of the population. So let me try to zoom out this thing. So, okay, so basically, I already told you everything, I think. But basically, what we are looking for here in Chicago is to invest in logistics, to invest in some brand new building, probably 60 to 100% leased. So we already have the list in place, and then hold it for 5 to 7 years and sell it. Okay, because in 5 to 7 years it will be a stable market, and we will have, if we sign, for example, if we have, let's say we have this we purchase this big industrial building, 200 and over square feet, and we have 60% leased, we can sign the other 40%, and we can sign escalations for 5% right now, because the market, it's prone to that. We can do it, okay? But if we try to develop something which is the other strategy we can do here, it's on the next, when we finish the building or the development, we will have we will not be able to sign escalations as high. Okay, we will lose probably 2%. Okay, so probably we can develop a new space, but it is risky for me because we have many square feet under construction, and we, in 2 years, we will compete to many more space than today. So I would say on the big buildings, 200,000 and over, I will go for acquisition or core strategy, maybe core plus, or even value add strategy if it's leased 50%, let's say. I will take more probably 60% and over. So that will be probably a core plus strategy. Okay. So for the small bay, I will not take small bay. I will not take small bay because one thing, I don't see a trend here. I don't see like the population growing, the salaries growing, the household income growing, and more people moving in Chicago. I don't see that. I don't see a trend here. I don't see a trend. I just see, how do you call something more immediate. So all these companies stop to take the decision to lease maybe for 3 to 4 years, and then they are taking that decisions. Okay, but maybe in 2 to 3 years, market will come to normal again. So that's why I would invest in bigger buildings and bigger, newer buildings, and lease it 60% and over. So that's what we are going to chase. We're going to, let me show you. We're going to try to find these type of properties. So let me go back, and let's choose for sale properties. Chicago or industrial. I will not choose this time flex because we are looking for only industrial for logistics. Property size 200 and over, and we want for sure existing, and we want, let's see, existing, and we want this sale. I'm trying to choose the core properties, zoning, system. Oh my god. Construction type, zoning, power, airport. Oh my god. No payment. Sale conditions. Sale type. Basement. Sprinklers. Secondary. I don't know where it's that. Secondary. Posted. Industrial. Says, oh my god, I'm looking for comps. Yeah, this is comps. I have to look for sale properties. Okay, that's why I didn't find it. Strategy. Property size 200 and over. Industrial. Oh, I'm Austin. I don't know why every time I refresh the screen here, it comes down to Austin. Investment type. Okay, as you can see here, investment core it's 90% and over. In value add, it's 60% and over occupancy. Okay, so let's select core and let's find how many properties we have. We have 19. Let's select value add 21. Okay, so let's select both. Okay, so we want something that it's already listed in. Okay, let's see the properties. Okay, let me see. Let's filter a little bit more for properties that have been on the market for less than 1 year. Status, only active properties, days on market, less than 1 year. Let's do that. 10 properties, okay? So let's see this one. Okay, 1998, only new properties. Let me just filter up from 2020. Year built from 2020. What? We don't have new properties, guys. Okay, that's because we don't have many properties, new properties. I guess because they are being probably sold before they are finished. So let me just deselect this, show criteria, industrial, active. Okay, we want all properties, right? We only want properties that have leases in place. That's what we want. Okay. So let's see. Oh, and let's select higher the clearing size, clearing height. Let's select higher than 36. Building. I thought that already. I need existing. Let me show criteria. Criteria, okay, status active, existing. Clear height, okay, minimum 36. Oh my god, we have a scarce inventory here. Well, I'm gonna quit that filter. We have only 2 listings. Let me see the criteria. Active, existing, 36. Let me reduce the clear height a little bit. Maybe I find something around 32. Building 32. Okay, that's fine. 32. Okay, so this one looks good and has a disclosed sale price. So I'm going to select this one. Which one else? We have only 4 listings. Okay, let's see the property here. Renovated 2003, built 2000, built 1921. It's too old. Okay, this one looks good. It's a little bit old, but I'm going to sell it. Well, I don't know if it's old, looks old, but I don't like this one. It's too old for me. They don't even show the property from the inside. And then we have this one, built 1973. Looks good. 100% leased. I like it. So let me remove unselected. Okay, guys. So we have 3 properties right here. And I'm going to open a poll. I'm going to ask your opinion, which one you want me to analyze, to take a look at. So I'm going to give you 1 minute, and you're going to, if you're watching me on YouTube, LinkedIn, or Facebook, you can write the address of the property you want me to take a look on. So basically we have this one, the Marble is the first option, Marble Street. They're asking 42 million and it's 100% leased. It's 399,000 square feet, too big. But you know, the biggest rent rates are, or in vacancies are on these numbers, on this size. Property 2, Kilburn Avenue, price not disclosed, 231,000 square feet. And then the last, it's the 42nd place. It was built in 1973, and it is just over 200,000 square feet, 100% leased. Okay, so the three options: Marble Street, Kilbourne Avenue, and let me move my image so you can see all. Okay, so basically we have these three options. Option one, Marble Street. Option two, Kilbourne Avenue. And option three, 42 Place, 42nd Place. Okay, so let me know which one you want me to take a look on. Okay, so you can write only the street address. So again, option one, Marble Street. Option two, Kilbourne Avenue. And option three, 42nd Place. Okay, so let me know which one you want me to take a look. Okay, so I think we have a winner. I'm going to take a look on 24 Marble Street. Let me go back to the other side. Okay, I'm back. And let me show you a couple of pictures here. It looks like a new building. It is a new building. It was built on 2023. It's a big one. We already know we have the lowest vacancies on the biggest buildings. So that's good for us. You see, I don't know if this is a render. I think this is a render. Should see. Okay, so available size, basically 400,000 square feet, asking 42 million for a price of $105 per square feet. Clear height 32 feet, columns 50 feet by 50 feet. It has 20 docks and 2 drive-ins. You know, for distributions, it's better the docks than drive-ins, but you for all buildings, I would say it's good to have some drive-ins. Otherwise, if you don't have, you can you can build a ramp and get inside through the dock. But I think docks are more important for distribution, at least. Floor thickness 6. Okay, air conditioning, smoke detector. Let me see. I don't see how much of the space is leased. Let me see the flyer. So I'm going to show you the flyer. Let me change this. Replace for the flyer. Okay. So for sale or lease. Year built. I don't see. I think it's vacant, 100% vacant. It's asking rent 6.9, triple net. Purchase price 42 million. Okay, so it's 100% vacant building. So basically, they're asking 42 million for a 100% vacant building, which is not bad because we have strong demand on that size of buildings. And we can sign better leases maybe because we are right now at the peak. So let me go back. Okay. So let's try to find out some number for here. They are asking 6.9. So let me just find the analytics, property. Triple at 6.9. Okay. Let's go to the analytics. Let me show you this. The analytics. $6.9 for this property. According to Submark, to CoStar, we can charge higher rents, but we go for 6.9 for the property rent. Let me find the cap rate for logistics. And 9.65. Okay. So we just multiply this number 6.9 by the RBA. I'm gonna give it 90% occupancy. So I'm gonna then multiply 4.9 because we are taking some time to rent it out. So 6.9 multiplied by 399,000, and this will be very close to the NOI. Okay, since it's a triple net, I'm just going to multiply by 0.9 because we are taking some time to lease it out. So it's 2.5 millions NOI. So we just divide by the cap rate, which is 9.65. Okay. So the price should be around 25 millions with that cap rate. But one thing is, this is for all the logistics market, the cap rate. Peers, let's see peers. I don't see the cap rate here. So maybe the chosen cap rate is a little bit too high. So if we go with an 8% cap rate with this property, it will be 31 million. So they are asking 42. So maybe we can get a little bit lower price for this property. So I would say between 35 million instead of 42, but we have to find the cap rate of the not of the market, but for these type of properties for sale. We have to find some sale comps in order to find the cap rate. Okay, but let me go back and let me try to replace. Okay, so I would offer 35 million for this property. I think it's a good price, especially because it's vacant. Okay, but we can sign some good leases here. It's risky because it's a lot of space, but in the next year, according to the report, we are having a strong demand for Chicago and for this type of properties, and we can subdivide this property. I think we can subdivide, let me see, 150,000, so we can have probably at least 3 tenants. We can have at least 3 tenants here, or at most 3 tenants. So little bit risky, but with the strong demand on the next years on this market, I will definitely make an offer for this property lower than they are asking for. But I will think we can do some good business there. So basically, this is the idea or the strategy I will do in this market. So what do you think about it? What do you think about this property? How much would you offer for this one? Which cap rate would you consider on your underwriting? Let me know on the comments. And also, if you're watching me on YouTube or Facebook or LinkedIn, subscribe so you can see every week I make a live like this, chasing the deal. And so if you subscribe, you will not miss the next live. And also, if you want to invest in commercial, you don't have to have millions. You don't have to have 35 or 42 millions like this property. Like they are asking for this property, 42 millions. You don't have to be a millionaire. You don't have to run a big fund. You just have to, you can join to my investor club, where we can find deals like this or opportunities. And if the numbers make sense, we invest, but you can invest along with us. So you can invest from 20,000 square feet in the small properties. In bigger properties, maybe the ticket will be higher, but you can invest from 20,000. And I will leave you the link on my description. And that way, if I find an opportunity, I will send you an email and you can join and you can know more about that deal. So you can join from 20,000. Or if you want, if you have, maybe you are a fund or institutional investor, I can also help you with that. I'm a real estate agent, commercial real estate agent with EXP. So I can help you find an industrial property as a buyer all over the US. We have an extensive network of real estate agents all over the country. And we have also real estate agents in 24 countries, more than 24 countries all over the world. So I will leave you both links on my description, and you can contact me and tell me more about your deal. So thank you for watching me, and see you on the next